and we'll get into it. All right, so the first slide that we're looking at is the overall economic information. And the biggest barometer of the economy right now is GDP. So it's looking at U.S. gross domestic product through time. I'm sure you're familiar with this chart. I'm pretty sure I've shown it before in the past as well. So the left-hand side, what we're looking at is historical trends. I'll use my notes here to kind of look at the trends that we're looking at for GDP. And the teal bars there is looking at the overall forecast for where we expect the economy to go into the future. Now, what you're seeing here indicates that we will go through a plateau in the overall economy. You can see the stagnation coming on the left-hand side over the next quarter or two, but it will not be defined by the actual word recession. And recession indicates 2 consecutive quarters or over 2 quarters of consecutive decline. We're not going to see that. We're only going to see 1 quarter of decline coming from the consumer side of things, meaning the products and services that you sell in your business on the consumer side, you want to focus on that compared to more industrial related items such as oil and gas or other industrial related manufacturing markets. Because on the right hand side, we're seeing the growth, and it's only going to trough out right above the zero line. So we're actually not going to go through a technical recession in the consumer economy. We will feel a slowdown, but it will not be crazy. It will be mild, it will be manageable, and you're able to get back on your feet again. And given the way that your business or your businesses in the aggregate perform, what we're seeing is that we do expect that there will be a rebound.
Oh, hi, how are you?
To the second half of next year. All right. So you've seen this chart before in the past. What we're looking at here is overall net migration. And in terms that if you're operating on a national scale, overall U.S. scale, you want to focus your eggs in that basket of the blue states, because that means more people are moving there. This is migration patterns. If people are moving to those bluer states, which is what it's indicative of what we're looking at here, that means there's more people that are spending. There's more demand for housing. There's more demand for building new jobs and building new infrastructure, which your businesses likely are tied to. So focusing on those bluer states means there's more people. There's a larger opportunity bias in those bluer states compared to the more salmon color states, meaning people are moving out of those areas. Meaning there's less people there. There's going to be less demand. That's going to be a natural hindrance on your business in those particular states. So focusing on those bluer states are going to be crucial in terms of a marketing or a sales tactic to gain that market share, to find the new opportunities coming your way. I believe you also in the past, if you've heard me do the last webinar, you probably saw this chart already, but I always like to show it. I think the states have changed up a little bit. We updated this chart, but it really goes to show the sheer size of the U.S. economy. I mean, California's economy is the size of India. It's huge. When you compare each state's economy to another country, it really puts it into perspective of how large the U.S. is. And that's what we're looking at here. We're looking at how large the U.S. has such a large purchasing power. So, last time I talked about the population-wise in the globe, North America is roughly 6%, give or take a couple percentage points here and there, of the global population. So people-wise, the U.S. in general is less than 6% of the global population. When you look at the size of the economy, which is GDP, looking at the spending patterns, 24% and change, above 24% when you look at the economy. So the U.S.'s purchasing power is huge. It's immense. It's the largest economy in the world, and it will remain the largest economy in the world. Now, this is a new chart that I like to show. It's looking at the average price of a date in the U.S. So this is just like a fun chart I like to work in just as a fun talking point and looking at how expensive it is to go on a date in certain states. So I'm from New Hampshire, which is pretty up there, $184 which is pretty aggressive. But you probably want to, drive into those North Dakota, South Dakota states to go on a date to keep your costs low, compared to, let's say, New York, which is almost $300 for a typical date. All right, Warren Buffett always said, red or blue, you can still make green. We're in the midst of, the election cycle where there's a lot of political advertising going on. There's a lot happening in the general U.S. right now with the advertising itself. At the end of the day, ITR advocates for, we're unbiased toward red or blue. We are politically unbiased. We look at not politics, we look at policy. So Warren Buffett said, red or blue, you can still make green. There is no statistical correlation between the white line, which is the economy, that's GDP that you're seeing here, compared to whether or not there was a Republican or Democrat as a president at the time. And the same holds true for Congress. If you look back all the way from the 70s onward, we did the study that actually looked at the typical GDP growth, the average GDP growth throughout that time till now on red or blue. And they're both at 2.8% average throughout time. So we don't hang our hats on whether or not we expect a Republican or Democrat to be president at the time. The U.S. economy is much stronger, and we definitely look at more than just red or blue. We look at policy. We look at the stronger economic forces at play that are telling us we're going into an economic decline. Because right here, there's no correlation, there's no statistical significance out of this trend here in the white between red or blue. The U.S. is just a larger economy. We're going to move the needle in terms of the economy at force or at play compared to, in Washington. All right, so let's look at more what you guys probably relate to. So we're looking at U.S. industrial production. We'll get to how you relate to this trend later, which you move very well with what we're looking at here. So this is a really important chart to look at. Very similar to the structure, sorry about that. Very similar to the structure about what we saw in GDP, but we're looking at a similar trajectory. The only difference between GDP and U.S. industrial production is the fact that we are going to see some recessionary periods in U.S. industrial production into 2020. And that's what I'm seeing. My mouse is hovering over on the right-hand side there, is that the forecast, the growth rate, is actually going to go below zero. We're going into a technical recession in the industrial economy, which if your business moves with the industrial economy, you'll probably feel that headwind as you head into the next few quarters. So knowing it's coming, preparing for that downturn is crucial, because your competitors may not know that this is coming your way. They may not be starting to hoard their cash to prepare for the downturn. They may not be starting to maybe getting rid of their C players in their business. And that's what will make your business come out on top of the rest, is knowing that there will be a downturn, because all businesses, all economies, all markets move in a cycle. There will be periods of rise, there will be periods of decline. Knowing that it's coming, understanding that it's going to be there, is so crucial, because you have that upper hand now against your competition. Most likely, any business is not impervious to a recession. They're going to go through it. They're going to go through ups and downs. We are close to that period of a downtime, which we'll see in your own data as well. So knowing that it's happening is going to give you that huge economic upper hand compared to your competitors. And it's important also to know where you're positioned in the cycle, because just because when you open up, the Wall Street Journal, you open up some news outlet, doesn't mean that when you hear or read that the economy's on a downturn, that's when your business is going to be on a downturn. You have to position yourself, okay, well, am I upstream, am I downstream from the overall economy? They say, okay, well, GDP is at X% growth or X% contraction this quarter. You could lag GDP, you could lead GDP. So it's important to know, all right, well, I have to make that mental transition. Well, if GDP, if I lag the economy by 2 quarters, 3 quarters, which we can help you to understand if you're interested in that as well. If you lag it by 2 quarters, that means that you're seeing good things right now. You're gonna see good things for the next 2 quarters. So understanding your position, and this is a great example that we're looking at here, is looking at the overall industry right now, where we see housing is one of the front runners, where it's in the downturn. It's more to the right than all the other industries that we're seeing. Whereas non-residential construction, you can see it's all the way more to the left. That's a lagging indicator. So it depends on the verticals you want to focus on. Right now, you want to focus on the non-residential side, the medical side, because those are lagging markets where we can see the overall growth trend happening right now, whereas housing is actually down, financial is down, new orders are heading into that downturn. Positioning yourself in an appropriate situation to really gain market share and really gain the value of what's happening in the economy is going to give you that extra insight to gain market share and to really give yourself that boost for your business. All right, so what's telling us we're going to go into a decline? What's telling us we're heading into a downturn? We have a forecast for the economy. We have a forecast for your overall industry as well for MTI. Now, what we use is the leading indicator program, and what you probably have seen in the past during my conversations or my previous webinars is this chart as well, but it goes to show that we do expect more decline to come from the overall economy. Now, this blue line that you're looking at here is the overall economy. It's looking at the trend in the solid blue line of U.S. industrial production, which you relate very, very well to, at least MTI does in totality. And we do expect that forecast in the diamonds there to go more into decline. Now, what's saying that? What's telling us that we're expecting more decline? Well, it's our leading indicator. So everything that's about to pop up right now, it's already shifted to the right to accommodate for its lead time relationship to the blue line, which is U.S. industrial production. So what this does is the first one that's about to pop up is the G7 indicator. You probably heard the G7 summit. That happens a lot globally in the news outlets. This is looking at 7 large macroeconomic countries' trends that we're looking at. Now, the solid orange line goes much more, the end of that point, that data point, goes much farther to the right than the end of the solid blue line. What this does is historically we match up the cycles. We match up the highs and lows in the business compared to, or at least the industrial economy compared to the G7 indicator. Now, what this tells us is that if past precedent holds true for the future, we're going to see likely more decline, because this orange line is telling us we're going to see more decline if the past precedent holds true into the future. Now, we rely more on just one indicator. We want to make sure that we're looking at more than that. So we have the Purchasing Managers Index, a confirmation that we're going to see more decline. We have the Wilshire Market Cap in general decline. That's a stock market related indicator. We also have the JP Morgan Index or indicator that's telling us that, you know what, our low that we expect in mid-2020, that's likely going to happen because we've seen that uptick even in the green line. So the purple and the green line tell us we're likely going to see a low point happen if we draw a line down right there in mid-2020. So know that over the course of the next roughly 3 quarters, things will be probably more of a headwind than a tailwind, but it's not going to be aggressive. It won't be severe. Be prepared. Try not to cut back your staff just because it's a tight labor market and things are going to be back to the races again as we head into the second half of 2020. All right, let's talk about prices quickly. Prices, a large reason that, or large impact at least, that when we look at prices is the interest rate environment. So our interest rate expectations and forecasts is 100% driven by the height of the Federal Reserve Chairman at the time. I've probably told this joke a million times already, but it also holds true as of lately, where we have Jay Powell now kind of ruining that trend for us, where we had Volcker, Greenspan, Bernanke, Yellen, all corroborating the general descent that we've seen in that red line, which is interest rates. Now with Jay Powell, we really don't expect rise to happen, so he kind of ruined this forecast for us. But at the end of the day, we do anticipate pretty much flatness out of interest rates, not a whole lot of movement to go on. So know that over the course of the next couple of quarters, it still will be favorable to borrow if you have enough cash on hand. That's going to be an incentive as we head into the downturn. interest rates go down because they want to incentivize borrowing to boost the economy again. And that's going to spur activity if you have the cash on hand to invest, to prepare for what's to come into 2021. That's going to be crucial. Excuse me. So kind of a different story here that we're looking at is overall consumer prices and producer prices. The orange line there is the consumer price. That's what you, me, every day go out shopping. That's the kind of pricing pressures we feel there. Now, I'm sure that a few quarters ago when I was talking on this subject, I probably told you to raise your prices, raise your prices, raise your prices. It's a little bit different now because a couple quarters ago, the blue line was much higher than the orange line, meaning producer prices were much higher than what we were passing on to the consumer. Now it's a different story. The blue line are producer prices. Producer prices are actually pretty much stagnant. They're the same that they were last year, where consumer prices are rising. This is your chance. Prices are always sticky on the way down. You're quick to raise your prices, but you're a little bit slower to drop your prices because you want to gain margin. You don't want to drop your prices so aggressively, and that's normal out of business practice. So to see that producer prices are declining and consumer prices are still at almost 1.7% indicates that you can gain market share. If you just leave your prices where they are, it's going to be harder to raise them. I'll give you that. It's going to be much more difficult to raise your prices over the course of the next couple quarters than you could get away with a year ago, where the blue and the orange line were much higher. Now we're not in that predicament anymore, but you could still get market share if you're aware that overall pricing pressures on the blue line input costs are down compared to what you're passing on to the consumer, which is at that 1.7 level. So really utilize that basically that assumption that prices are sticky on the way down than they are on the way up. Utilize that, gain market share, gain margin as we head into the next couple quarters. And that's reflective as well in overall commodity prices. We're looking at copper, zinc, steel, aluminum, all those colorful lines that we're seeing here below last year's level. They're all negative. So I know the title says all except for steel. I know steel is actually down right now. I'm just a little bit hesitant because of the whole tariff situation going on, that it could contribute to potentially near-term upside pressure. But at the end of the day, commodities are all down because China, Western Europe, Eastern Europe, Canada, the US, they're all in an economic downturn right now. Whether it's a slowdown, whether it's an actual recession, all of those major macroeconomic nations are in the decline that we're seeing. And that's going to contribute to lower pricing pressures, because when the economy slows down, that means there's less demand. And when there's less demand, that means there's lower pricing pressures. There's not as many people requiring this product. Let me lower my price to get people to bite. We're seeing that happen and start to develop right now. We're seeing the little nudges that are happening with these companies that are, okay, well, you don't want to buy my product at this price, I'll lower it because we need the business. That's what's happening in this environment right now because of the slowing trend. No, this is going to happen. It will not last forever, though. All right, quickly talking about tariffs. I don't want to spend a whole lot of time. I know we only have about 10 minutes left. So the big thing with tariffs is looking at, who's suffering more. So what we're looking at is exports to China versus China imports. What we're seeing is, if we look at where the blue line is our imports from China, we're still at a pretty good level. Even it has been declining. You can see the blue line in decline as of recently. But if you were to draw a horizontal line, pretty much still at a good level when we compare it to the historical trends. Now, if we move down and look at the exports to China, meaning what is China importing from the U.S.? If I were to draw another horizontal line from where it is right now across, China's imports, so the U.S. exports to China, are actually at almost the lowest level since coming out of the Great Recession. If you drew a horizontal line there where my mouse is going. China's suffering more, and they're suffering harder, but they're willing to do that because they're very prideful. The U.S. is not as, the U.S. is prideful, but they're they don't like to sacrifice their economy for what's going on. China will. So that's what we're looking at here, is the difference between the fallouts between the two is that China is suffering longer and harder, but they're willing to, and that's what we're looking at. And feel free to comment too. I believe that there is that option to send in your comments in the Ring Central app if you want me to answer any questions you have on tariffs. All right, quickly, I will touch base on the long view. So the 2030 Great Depression that we're seeing, we're expecting a 2030 depression. And right now, the drivers to that are demographics, healthcare costs, entitlement programs, inflation, and national debt. And the biggest driver right now that we're looking at is this chart here, where we're looking at the delta or the deviation between the red and the blue line up here. So our current tax receipts, so what we're taking in, the blue line, versus our transfer payments, that's Social Security, Medicare, Medicaid. Our debt is growing, and we have 10,000 baby boomers a day, each and every day, retiring. That's going to be huge as we head into the next 10 years, when the last of them retire, the last of them are requiring Medicare costs, which is going to drive up demand, which is the law of economics. You drive up demand for something, that's going to drive up the price. So inflation on the medical side of things for a huge demographic group, such as the baby boomers, is going to cause a huge burden on the U.S., and that's going to incur a lot of problems and a lot of issues in the overall economy, and that's going to drive us into a depression, which happens to be almost nearly 100 years from the 1929 depression as well. This is kind of an image I like to show looking at it. It's talking about that the next 10 years will be the roaring 20s. You can see the green line in general ascent. I will point out the fact that a lot of people thought the roaring 20s, this is the 1900s, by the way. This is what the economy was in the 1900s. Actually went through 3 recessions. So in the early 1920s, the middle of 1920s, and the latter half of the 1920s, there was actually 3 recessions. A lot of people think, oh, the roaring 20s, it's definitely a time of prosperity and there was no recession. There was. But if you look at the general ascent, the overall pattern, it was rise. Similar to what we're expecting for the next 10 years, where we do expect recessions to happen over the course of the next 10 years, but it will be in a more of an ascent in the overall theme, and that's when kind of, so we're on the stairway to heaven for the next 10 years, and then we're on the highway to hell for the earlier parts of the 2030s. All right, so let's talk about you. Let's look at your own data. What we're seeing here for the last 5 minutes or so is where your overall average monthly sales came in at. Now, I don't want to focus more on the number here. I'm going to focus on the growth rate and the direction. So we can see October 18 all the way to September 19. What I saw was the latter part of 2018 into the early parts of 2019, kind of an overall ascent. If I were to draw a trend line, it seemed like things were going well from late 2018 into early 2019. What I've seen lately is a very, I don't want to call it a plateau, but a kind of a mild decline, where things have been generally stagnating, which makes sense because our economy right now on the industrial side is going through a mild slowdown. And that's reflective up here, where we can see the phase cycle from the green to the yellow, where we're starting out at 11.7% growth from October 18. We're now at 10.3, so you're still doing well. You're still growing year over year in the double digits. That's awesome, that's excellent, but it's not where you once were from the early parts of 2019, where you were at 13.6% growth. You're now at 10. So that trajectory, given you're moving with the overall economy, which is what we're seeing in the trends in U.S. industrial production, suggests you'll likely see more decline. And that's why we expect the overall direction of MTI as a whole to move in the general descent pattern. Knowing it's going to be mild, knowing it's going to be manageable is crucial, because you don't want to be cutting back on staff. You don't want to be cutting back on anything that will limit your capacity. Because the next few quarters, yes, they will be a little bit of headwind, where my mouse is pointing over on that left-hand side. But things are back to the races again, back to record high activity for MTI as you head into the later parts of next year and into 2022. So knowing that, you know what, you will face a headwind. There's ways to avoid that. I want you to beat the overall outlook of MTI. I want you to, if you gain market share, if you do, introduce a new product line, things like that will get your feet running to outperform what's happening in the economy. But in terms of growth, that's what the right-hand side is portraying, where we see that decline happening out of your overall business for MTI. Now, I already talked about this, but looking at comparing your business to the overall industrial economy, that's what we're looking at on the right-hand side, is the outlook for MTI versus the outlook for the U.S. industrial economy. Historically, the yellow and the blue move very, very well with each other. Those peaks, those troughs, they typically happen together. That drives our outlook for more decline into the overall MTI business or group, at least for the next couple quarters before things pick back up again. Same thing applies also for U.S. non-defense capital goods new orders. That's looking at overall B2B capital equipment expenditure activity. Very similar pattern compared to the U.S. industrial market. If at all, if we look at the historical relationship between MTI and B2B activity, I mean, almost spot on. If you look at those transitions, even this one, in 2007, you can see where my mouse is hovering over, even picked up that little blip. It's picked up almost every single cycle in overall MTI's growth, which is why we're expecting that more decline to happen into the future with those diamonds there. That's our forecast. That's not actually happened yet. It's our outlook, followed by rise. So know it's going to be a downturn. Know it's going to be mild, but it will be manageable. Which takes us into those 4 phases of the business cycle as we close out. It's so crucial to understand where you're positioned on the cycle. So if you move with the MTI's total grouping outlook, you're in the yellow phase right now. You're in that business cycle decline, but you're still feeling growth. Now that is a huge, huge thing to be aware about, is that transition from green to yellow, because there's very different strategies to take from green to yellow. Where yellow, you're still above last year. You're still growing. Your revenue, your sales, or whatever you're tracking in terms of your business is still doing well. It's growing from last year. But the amplitude of growth keeps getting lower and lower and lower compared to the green phase, which keeps getting better and better and better. There are 2 different tactics to take away. You want to start hoarding your cash. You want to start evaluating whether or not I need my C players in my business at this point in time. Whereas your competitors may just see, okay, well, I'm above last year. I'm going to go higher. I'm going to go invest in new capital equipment. That is the worst thing to do when you're in the middle of this yellow phase, because you could be in the red in 2 quarters. And that's what we expect from overall MTI within the next couple quarters, is for a slight negativity trend to happen. So knowing that there are headwinds coming your way over the next 2 quarters, be aware of it. Be very conscious of the fact that there will be those headwinds. There will be those challenges and obstacles coming your way. All right. So you can get the TR. I believe you may already have this, but forgive me if I'm wrong, on the trends report, which is basically about 45 to 50 forecasts of the overall economy and where it is in certain industries. You can get a free 90-day trial offer. You just text TR trial to 444999. It doesn't have to be just you. You can let your colleagues. You can let anyone else know, friends, family, about this. So for the free 90-day, 3-month trial offer, text that TR trial to 444999. I'll make sure you guys get a PDF copy of this as we conclude this PowerPoint, this presentation, and this economic update. So now, I kind of went through all of the important topics that I had, but I'm going to feel free to turn it over to you guys for any questions you may have. And feel free to reach out to, I do want to thank Tom Morrison for putting this together. He's been a huge, great asset in facilitating these types of conversations, which I think is very beneficial. So thank you, Tom, for putting this together again. I greatly appreciate that. I will send him a PDF copy of the PowerPoint today, so I'll make sure that you guys get access to the slides that I showed. But I will turn over to questions. As of right now, I don't think I see any, but so I'll give it maybe 20 or 30 seconds or so for you to fill in any questions that you may have. All right, I don't see anyone chiming in, but you have my contact information, or at least Tom does. Oh, I see one question coming in. How are you seeing? The question is, how are you seeing things trend like industrial gas and electricity commodities like that? So I'm assuming the question was asking what do we expect out of those industries or in terms of our forecast? So are you seeing things trend like industrial gas? So in terms of electricity kind of moves in its own little world. We do have an outlook for that, and it's for further business cycle decline. So we do expect near-term decline coming from electricity, followed by a rise. But commodity-wise, such as oil and gas, that right now, I know there's been stuff in the news lately about Saudi Aramco and them going public, Saudi Arabia Oil Company, things like that could drive prices. So we do have forecasts for commodities that go out for quarters. We typically do 3 years, but 4 quarters, because it's commodity related, it's very speculative driven, will drive that trend. As of right now, the decline that we're seeing in the overall globe with China, the US, Western, Eastern Europe, declining demand will drive down the price for commodities. And that's what we're observing, is general flatness, if not stagnation or decline, coming from oil and gas, because of the fact that it's demanding less globally. All right, that was the only question I had, but no, I keep talking and questions keep pouring in. I see a question saying, do you see government restrictions on EPA standards restricting growth? We actually had we actually had a whole conversation about this earlier this week. We had a whole chat with all the economists together talking about CO2 emissions, and Europe's on that train right now. And at this day and age, I think that it's very politically driven. So it depends on who has control and power, which is hard to say at this point. Who has the opportunity to do those restrictions with government wise with the EPA. We saw the Obama to Trump administration even with coal. We saw a huge liberal policy getting more contact with coal once Obama shifted to Trump. Now we're seeing a little bit of a different tactic depending on all of the election cycles and all of the arguments being made by the politicians with the left versus right-hand side. So it's hard to say without knowing the exact result, because again, we are politically unbiased. We do look at policy though. So at this point in time, I see the U.S. still as very capitalistic than socialistic, and there's incentives to everything, where even if it's solar panels, the tax break you get on solar panels is the incentive that you have to get them, not because that you want to actually, I don't want to say not help the environment, but it does help the environment, but there's a huge incentive to do that because of the tax break. So it's still very capitalistic, and at this point in time, the only way to become more EPA friendly is to make rules on it, not make morals on it. So I hope I answered that question. I know that was kind of a long rant, but at this point in time, I don't see those restricting growth until it actually happens, but certainly it could impact it. But there are definitely incentives that are I guess, I want to word this correctly. The incentives are more capitalistic centric than the environmentally friendly incentives. So I have another question saying, I saw the discussion trending of MPI versus industrial and non-defense capitals. Do you offer a defense? Yes, so actually the trends report, the ITR trends report that we release monthly has a defense capital goods new orders series. That one provides a 3-year outlook for just defense, not non-defense, which is, it's much more related to, I guess, Washington and Capitol Hill. So we do have a forecast for defense capital goods new orders. A lot of it is somewhat biased to political trends that are happening, as well as shipment trends and what's going on in the world. So we do have an outlook for that. If you want to subscribe, I'll go back to the page where you can utilize the trends report for that defense capital goods new orders. But we do have that, yes. All right, well, thank you guys for joining me today, and thank you again to Tom Morrison for putting this together, and I'll make sure to save a copy of this conversation. I did record it, and we'll send it your way, and you'll also have a PDF copy of the slides. So thank you everyone for joining today, and I hope you have a great day.